Whenever there is a major tax bill, the one question on everyone's mind is, how does the new tax bill affect me? The answer to this question depends on your individual tax situation. The Tax Cuts and Jobs Act, as stated in its name, is being sold to the American people as a tax cut. For many it will be, because the most basic feature of the tax bill is a reduction in the tax rates for certain levels of income. The new tax law retains the current structure of 7 tax brackets, but the tax rate for each bracket is reduced by 0 to 4 percentage points. This reduction in the tax rates is good for all taxpayers. But the law makes many other changes that will affect the calculation of your taxable income. Most notably, the standard deduction has been increased. This is a positive change for many taxpayers. However, the personal exemption has been suspended. Why do I say suspended? Because many of the changes affecting individuals will expire on December 31st, 2025, including the changes to the personal exemption. To see how these 3 changes will affect taxpayers, let's look at a simple example. Let's assume you are a single taxpayer with $30,000 of salary income. You have no other income sources, and you do not itemize your deductions. Under the old law, you would claim a standard deduction of just over $6,000. But under the new law, your standard deduction is $12,000. However, you will lose a $4,000 personal exemption under the new law. The result is a moderate decrease in your taxable income under the new law. Additionally, you will be taxed in the 12% tax bracket instead of the 15% tax bracket. The end result? A decrease of $500 in your tax. In this example, that's a 20% reduction in federal income tax under the new law. But what happens if you are married? Let's assume you are married. You and your spouse have $60,000 in income. That's twice the income as the previous example. You have double the standard deduction, double the personal exemption, double the taxable income, and double the tax. In this example, you have the same 20% tax savings as 2 single individuals making $30,000 each. Now, a 20% tax cut sounds pretty good, right? Let's see what happens if you have a little more income, some kids, and some itemized deductions. You are still married, but this time, you and your spouse have a combined $120,000 in income. We will assume that you have $23,000 of itemized deductions under the old law. Since this is less than the new standard deduction, you will not itemize under the new law, but your deductions increase $1,000. You also have 2 children below age 17. Under the old law, you would take 4 personal exemptions, 1 for you, 1 for your spouse, and 1 for each child. Not so under the new law. So with the changes in the standard deduction and the suspension of personal exemptions, your taxable income is $15,000 higher under the new tax law. And a 3% decrease in your tax rates is not enough to offset the increase in your taxable income. But the new tax law increases the child tax credit from $1,000 to $2,000 per qualifying child. The increase in the child tax credit gives you a net reduction in your income tax of about $1,200. In this example, that's a 12% tax cut. But why do you receive a $1,500 child tax credit under the old law? Under the old tax law, the child tax credit was decreased for married couples with income over $110,000. So in the previous example, you would only be able to claim a child tax credit of $1,500 for 2 children if you have $120,000 of income. However, in addition to increasing the child tax credit from $1,000 to $2,000 per child, the new law also increases the phase-out income levels from $110,000 to $400,000 for married couples. So in the previous example, your tax credit of $4,000 for 2 children is not limited. This is a huge change for taxpayers with children age 16 and younger. Let's look at one more example. What will happen if your 2 kids are over 16? Remember, the child tax credit is for children 16 or younger. The age requirement has not been changed by the new tax law, but the new tax law provides for a new credit. Under the new law, taxpayers may now claim a $500 credit for dependents other than children qualifying for the child tax credit. And the income phase-out for this credit is the same as the phase-out for the child tax credit. This is a good change for taxpayers with older children and other dependents. So here's what happens in the previous example if your two children are over 16. Under the old law, you do not get a child tax credit for your children due to their age. But now, you can claim the new $500 credit for your two children. However, even with the new tax credit, your tax in this example is $300 more than under the old law. So the Tax Cuts and Jobs Act will not give everyone a smaller tax bill for 2018. But what about education credits? If your children are dependents and are 17 or older, they may be in college. The new tax law did not make changes to the various education tax credits. So these credits are not illustrated in the last example. Even if you were able to claim one or more education credits for your two older children, the previous example would still result in a $300 increase in your taxes under the new tax law. So remember, the Tax Cuts and Jobs Act may not be a tax cut for you. Even if your tax situation is relatively simple, you may not have much of a benefit from the new tax law. And depending on your situation, you may pay more in federal income taxes. So when the IRS issues new withholding rates, your employer may have you fill out new withholding forms, and you are going to expect your paychecks to increase due to less federal tax withholding. But that may not be the right answer for you. So be careful. You do not want a balance due next year when you are expecting a refund. In summary, we have discussed 5 provisions added or changed by the new tax law that will affect most every taxpayer. Tax rates have decreased. This is a good change for all taxpayers. The standard deduction has increased. This is a good change for many taxpayers. The personal exemption has been suspended. This is not a good change for taxpayers, especially those with children and other dependents. The child tax credit has doubled. This is a good change for taxpayers with young children, and with an increased phase-out, many more taxpayers will qualify for this credit. The dependent credit has been created. This is good for taxpayers with older children as well as taxpayers with other dependents. Just remember that the credit may not be enough to offset the lost personal exemption for each dependent. And remember, the various education credits remain unchanged. So that is a brief overview of how the new tax law may affect you. Just remember, everyone's tax situation is different. Please consult your tax advisor to see how the new tax law will specifically affect you.